Hello and welcome to this Forex Preview at XM.com. We'll be discussing upcoming U.S. data and the outlook for the dollar. I'm Maria Pachordes, and joining me is Senior Investment Analyst Marios Hadjikyriacos. So Marios, at the moment, fears of a recession are at the forefront of everyone's mind. On Thursday, we'll get the core PCE price index for May, and on Friday, the ISM manufacturing index for June. What market reaction are we likely to get from this data, and what should traders be looking out for?
Well, the market reaction is tricky, Maria, but let's take a step back. So what has been happening lately in the markets is what I think the most important thing here. And in a nutshell, we've gone from panicking about a really high inflation to worrying about a potential recession. What we've seen specifically, well, we got the signals in the latest PMI business survey. So there was a comment to the tune of companies reported a remarkable drop in demand for goods and services. Business confidence has been falling, consumer confidence has been falling. We've had major retailers like Walmart, Target, people that can really do supply chains right, complaining that they have a lot of inventory, that they can unload, that they bought too much, essentially, during the height of the supply chain crisis. We've got the housing market cracking, and we've had signs that hiring is slowing down. So, you blend all of it together, and it looks like the US economy is losing steam. And of course, the markets are very well aware of that. We've seen inflation expectations roll over lately. We've had the terminal federal funds rate in the markets being revised lower. Now the investors only think we're going to get to 3.5% as far as interest rates go. What does all of this mean, and why am I mentioning it? Well, it's really simple. The markets are saying, yeah, the Fed is going to get its wish. Inflation is going away, but it's going away the hard way. It's going away because the economy is probably going to suffer and demand is going to fall off a cliff. Now, in this light, we're going to get this week's data. On Thursday, the Fed's favored inflation metric. It looks like core inflation has already peaked, and these data are probably going to reflect that. The markets don't usually move on the core PCE index, but on Friday, when we get the ISM manufacturing PMI, we could get some really decent moves because if you're worrying about a recession, you usually look at the business surveys to get a sense of where the economy is going, because some components of the business surveys, like new orders, those are forward-looking indicators that can predict where the economy might be 3 months or 6 months. So the markets are going to pay very close attention to that. From the regional surveys that have been released so far, it looks like it's going to be a disappointing number, and if that is the case, we might see some bets for Fed rate increases being dialed back a little bit further, and that, I think, is going to be a slight negative for the dollar.
Turning to the bigger picture, what's the outlook for the dollar?
Well, here's where it gets really interesting. We might see a step back on Friday, but I think the overall picture is still positive for the dollar. And it really comes down to the following. There's nothing to replace the dollar right now. The dollar is the only major currency that offers both high interest rates and safety in terms of being the reserve currency. And really, you have to look at the euro and the yen. You have to look at the opposite side of the coin to understand what is really going on. And what do I mean by that? The euro and the yen have been plagued by high energy prices. Now, historically, the euro and the yen, their historical advantage was always that the Eurozone and Japan had massive trade surpluses. Japan with electronics, the Eurozone with cars and other things. They used to run chronic trade surpluses, and trade surpluses are positive for a currency. Now, because both of these economies are energy importers, they are now running huge trade deficits since energy prices have gone through the roof. So while this is the case, I think they are very unlikely to rally. I think that any rallies in the euro and the yen are going to remain very shallow, and therefore I think that the dollar is likely to remain king in the FX market for a while longer. Now, the secret, the key to a trend reversal in the currency market is oil prices. Oil prices are essentially at the center of everything, because if oil prices go down, that means the Fed doesn't need to be quite so aggressive with rate increases, which is negative for the dollar. That means the euro and the yen might have a breath of fresh air and manage to rebound. So, what oil prices do moving forward is the single most important thing, both for the currency market and for the stock market for different reasons. It's just at the center of everything. So, watch oil prices very closely moving forward.
Absolutely, yes. Marius, thanks so much, and thanks for joining us at XM.com.